Hey guys, how you doing? Hope you're well. It's Alessio. In this video, I want to talk to you about what's been happening recently in the major markets. And in fact, this specific data you're seeing here and what this data is potentially telling us for the rest of 2023. And by the way, in case you're wondering, why are we talking about the major stock markets? Why not Bitcoin or crypto? The reason is, as I'm sure you know, is because what often happens to the major markets, the stock markets, has an impact also on Bitcoin and the crypto markets as well, because there's often a positive correlation between the two markets. By the way, guys, in this video, I also want to talk to you about the issue of inflation, the kiss of death, and also the market that knows everything, the market that knows all. All right, guys, join me. Alright guys, welcome back. Before we begin, let me just say my apologies for the audio in this video. I don't have my microphone with me today, so I just have to speak a bit louder to get my voice across. I hope you don't mind. And also, I'm making this video for you from the beautiful town of Bournemouth in the south of the UK, south of England, by the seaside. Just really great to be here. And I think it's a good idea to take a break from the city and come to the seaside and just refresh your mind every now and then. All right, guys, let's talk about the markets. And I want to begin, first of all, with the recent action on the stock markets, the S&P 500, for example. So let me just begin, first of all, by playing for you what I said to our members for the last several weeks, going back to December. Here's a very short clip, and we'll come back.
Provided the S&P remains below near resistance 3977, pressure remains to the downside for a move into this region. We could see further downside pressure to test 3,900, and potentially might even move to 3823, 3,823, and there may even be a deeper pullback into 3745 as well. Generally, I'm looking for a move into this region. At the moment here, the higher probability seems to be for a continuation of this, whether from this region here, again, anywhere from this region, this box region here, this yellow box, potentially moving from 3,900 to 3823, or even lower, even down to the 3745 level, and then giving us the next push higher into from this region into 4144, 4155 to 4180, 4180 being the symmetrical projection.
All right, guys, welcome back. As you heard me say back in December, I was expecting a short-term pullback, a pullback to some specific regions, and then I was expecting the market to rally higher to our first target, which, by the way, we reached just recently. Our first target was at 4180. By the way, in case you're wondering, 4180, the reason why that level was important, that was the symmetrical projection. So if you measure the lows from, I think, the June lows to the August highs, and then you project that from the October lows, you get the 100% symmetrical projection that was at 4180 approximately, and that was the level we reached just recently. In fact, that was one of the first targets I had on my chart. By the way, I also warned our members in December that if the stock market was to break the 3,700 level on the chart, then I would have to change my mind and I would have to become much more bearish. But I did mention at the time to our members that that was a lower probability. In other words, I was not expecting that kind of scenario. My higher probability was for a move higher to our first target, in fact, on the chart at 4180 at a minimum. By the way, am I saying to you I got everything right about the stock markets last year? No, I did not. In fact, in January of last year, I was expecting the markets to make a correction, a temporary correction or pullback, but I was not expecting a deep correction or a bear market. So I was wrong about that. Now I realize some of you are probably confused at this point. You're probably thinking, well, what about the kiss of death that occurred back in late September of last year in 2022? Well, guys, as I'm sure you remember, I mentioned this back in my video at the beginning of October. I mentioned that it's quite likely that from October to December, we could see a Halloween effect. In other words, a period of strength or positive movement in the stock market between October and December, which is exactly what we saw in the stock market from October to December. And also, you may remember that in my video in October, I also mentioned the 5 warning signs which need to happen first to confirm or reconfirm the kiss of death. And as I mentioned to you in my December video, one of those warning signs did not happen.
I have my doubts at the moment as to whether this is the moment that the market is going to collapse again into a significant bear market and re-trigger the kiss of death. The reason why I have my doubts is some months ago I published a video you probably saw, and I mentioned the 5 warning signs that I'm looking for. You probably saw that video, and 2 of those warning signs did not happen. One of them was a move into resistance. The second thing is this: the stock market has not yet broken support. So my 5th criteria in that video was a market has to break support to reconfirm the kiss of death. The market has not done that either. So 2 of those important criteria have not been met.
And because we did not see a break of support, for example, we did not see the stock market break the 3,700 level on the S&P, therefore, there was no reason for us to become bearish. It's only if the market were to break that level at 3,700, then we would become bearish, and that would reconfirm a potential kiss of death scenario. And by the way, you may remember I mentioned this in my video interview recently with the trader Gareth Soloway, where I mentioned that as long as the S&P stays above the December lows, I'm going to remain bullish on the stock market. I'm cautiously remaining bullish on the market, which I know is controversial. A lot of people don't like me saying that, but I'm going to give the market the benefit of the doubt. So I'm going to remain cautiously bullish on the market. All right, guys, let's talk about the specific data here, courtesy of Manuel Bly, the Dow Theory. By the way, Manuel Bly is one of the few analysts out there that I really respect, and I like him a lot, because in his newsletter, he mentions some really interesting things. For example, let me just read something for you. This is courtesy of Manuel Bly, the DowTheory.com. He said in his recent newsletter in February that a lot of the people out there who think that inflation or high inflation is very bearish for the stock markets are actually probably wrong. Actually, history shows differently. Let me read this for you from the most recent newsletter from February by Manuel Bly. The US inflation rate for 2022 is 6.5%, a high print by historical standards. But what is likely to happen to stocks after a high inflation year? Manuel says, since 1959, I selected the year-on-year inflation rate above 6.5%, which is the most recent reading we had on the inflation rate, and the Dow Industrial's total return, dividends included, 1 year after. The table on the left shows my findings, and here's the table as you can see here. He says, out of 7 such years, only 1 was negative. 4 years resulted in returns exceeding 20%. The average return was 17.69%, which is much higher than average. Now, some of you are probably thinking, well, what about the 1970s? We had high inflation in the 70s. And here's what Manuel says. Even amid the horrible 1970s, high inflation years were followed by handsome returns, an encouraging sign. And as you can see here, the median return after high inflation years was 21.48% potential return for the stock markets, despite high inflation. So guys, does this data mean that the markets will definitely go up by 20% or 17% this year in 2023? No, of course not. There are no certainties. There are no guarantees. As we know, and as the analyst Jason Geppert says, we do not traffic in absolutes or certainties. We're only dealing with probabilities. What this data from Manuel Bly, the Dow Theory, essentially means is that we need to be careful about jumping to conclusions like many analysts out there are doing. A lot of the media pundits and analysts out there are mistakenly saying that because of high inflation, that we're definitely going to see a crash and a bear market in the stock markets this year. Well, as you can see here, the results show differently. We have seen that despite high inflation, even during the 1970s, there have been positive returns, strong returns in the stock markets the following year, despite high inflation readings. So again, this is not a guarantee. This is not a certainty that the markets will go up by 17 or 20% this year in 2023. All it means is that there is a potential. There is a probability, perhaps a slightly higher probability that markets could remain strong and bullish this year in 2023, despite high inflation and despite the Federal Reserve hiking interest rates. And by the way, as I mentioned earlier in this video, everything depends on the stock market remaining above the December lows. The December lows are still a key support level, and that level must be protected if bulls are going to remain in control and if potentially markets can go higher. And by the way, guys, I would highly suggest you check out Manuel Bly's and Jack Shanup's newsletter, the DowTheory.com. I'll put the link for you. Again, that's the link you see there in the description, the DowTheory.com/LT for more details on their newsletter. Now, let me just finish by saying one more thing, and that comes to the chart of the market that knows everything, the market that knows all. Now, if you've been watching my previous videos, you probably know which market I'm talking about. I'm talking about the bond market, and this is very relevant to inflation. You see, guys, as I mentioned to you in my video back, I think it was in December or beginning of January, if the chart of TLT, the 20-year treasuries, or the bond market, to put it simply, were to break above resistance, that's the level you see on the chart right there, that's the level of resistance, just near 110. If TLT were to get above that level and close above that level, then that would be a very strong signal that the bond market has very likely bottomed and we could see a bull market in bonds for the rest of 2023. And it would also mean that inflation has very likely peaked. Because remember, guys, when bonds are rising, it usually means that the forces of inflation are not so much of a threat anymore. So when bonds are going up, it means the forces of inflation are losing and disinflation is winning. But when bonds are going down or trending down, it means the forces of inflation are still a threat. So what I'm saying is watch the chart of TLT, the 20-year treasuries, very closely, because if we get a break and it close above that level on 110, as you can see right there, then that's a very strong sign that, again, firstly, that the bond market is bottomed and we could see a bull market in bonds for potentially the rest of this year. And also would be a very strong sign that inflation has likely peaked and that we could see lower inflation for the remainder of this year. Again, remember, guys, I am not saying that inflation is going to continue dropping forever for the long term. No, this could just be a temporary reversion to the mean. We could just see a temporary period of falling inflation, perhaps for a year or two, just like in the 1970s, where despite the high inflation, we had a period of falling inflation or disinflation, and then we saw rising inflation again. So the same thing may actually apply here as well if TLT confirms this by a break and a close above 110. Alright guys, hope this video has been helpful to you. If it has, please give it a like, and also please subscribe for future videos as well. Thank you very much indeed. Bye for now.